We're going to complete this chapter by discussing the closing process. And this is going to clearly show us the various purposes of preparing closing entries. So closing entries transfer the balances of all temporary accounts, such as revenues, expense, and dividend accounts, to the balance of the retained earnings account. Here's how it works. All revenue accounts have credit balances. To transfer these balances to the retained earnings account, we debit each of these revenue accounts for its balance, and we credit retained earnings for the total. We do the same thing with all expenses and dividend accounts, except the opposite. So they all have normal debit balances. So we're going to credit each of those accounts for its balance, credit those, and debit retained earnings for the amount in total. So we can transfer the balances of all revenue, expense, and dividend accounts to the balance of the retained earnings account with the closing entries shown in this illustration. Now, these closing entries have the effect of transferring the balances of all revenue, expense, and dividends to the balance of retained earnings. Remember when we initially talked about the expanded equation, that we talked about revenues ultimately increase our retained earnings, expenses and dividends decrease our retained earnings. This is how you see it really happening in true format, because truly, when we get rid of these temporary accounts, it ultimately all flows into retained earnings. So we call revenue, expense, and dividend accounts temporary accounts. They get closed out at the end of each year, and they close into a permanent account, retained earnings. A common mistake, again, some students believe that closing entries are meant to reduce retained earnings to a zero balance, but that is not the case. Retained earnings is a permanent account. It stays with us forever. It represents the accumulation of revenues, expense, and dividends over the life of an entire company. Let's look at an exercise problem 312. Now, we've got some transactions here, and we're going to record the adjusting entries, and then from there go through the process of the various transactions. So, on December 1st, 2018, Wolverine receives $4,000 cash from a company that's renting office space from Wolverine. The payment representing rent for December and January gets credited to deferred revenues. So as you see here, this is showing adjusting entries of what was recorded when the cash happened, and then from there, what we record when we've used up 1 month of rent. So initially, cash and deferred revenues were reported. After that, we adjust it by showing a reduction of a liability and increase in a revenue. Wolverine purchases 1-year property insurance on July 1st for $13,200. The payment's debited to prepaid insurance for the entire amount. Again, in here, the initial transaction had an increase of an asset, prepaid insurance. We used cash to pay for. When we utilized some of that insurance, we debited the insurance expense, we credited our asset. Employee salaries of $3,000 a month were incurred are accrued in December and aren't going to get paid till January, we debit our salaries expense, we credit our salaries payable. We borrow $15,000 from a bank, we need to report the interest that's been accrued. We will show the interest, $15,000 from a bank at a 10% interest rate for 2 months. We show the interest expense increased, the payable also increased. Office supplies were used up, so we purchased $3,400 more of office supplies in August, debited the supplies account. We only have $500 of office supplies remaining. We have to show all that was used, so we increase our expense, reduce our asset. Which account is not going to get closed out during the closing process? Remember, permanent account would be a retained earnings. So as we take a look at the post-closing entries and the post-closing trial balance, the post-closing trial balance is a list of all accounts and their balances at a particular date after we've updated account balances for closing entries. The post-closing trial balance helps verify that we prepared and posted closing entries correctly and that the accounts are now ready for the next period's transactions. This slide shows the post-closing trial balance for Eagle Golf Academy as of December 31st. Note that the post-closing trial balance does not include any revenue, expense, or dividends because these accounts all have zero balances after closing entries. The balance of retained earnings has been updated by the closing entries to include all the revenue, expenses, and dividends for the period. So let's see what you think here. Which of the following accounts would you find on a post-closing trial balance? Would we have dividends? Would we have retained earnings? Would we have rent expense or service revenue? Well, we know our revenues and expenses are temporary accounts and those go away. So we're not going to have those. So we would have retained earnings. Dividends also are temporary. The only one that is permanent would be retained earnings because the other three flow into retained earnings. Let's look at a great example to bring all this together. So in the back of the chapter, we're going to look at an exercise 317. Seminoles, let me pull this up here. Okay, Seminoles Corporation fiscal year end is December 31st, 2018. And the following is a partial adjusted trial balance as of December 31st. So we see here retained earnings, and then we see temporary accounts, dividends, revenues, and expenses. We are required to prepare the closing entries to close out these temporary accounts, and then our job is to calculate the ending balance of retained earnings. So let's look back here. The first thing we want to do is close out our revenue accounts. We see here service revenue of $50,000, interest revenue of $6,000. They normally have a credit balance. To close them out, we take the entire balance and debit it. We debit service revenue, we debit interest revenue, so we zero them out, and we make the offset to retained earnings for $56,000. This closes out our revenue accounts. We look back, our expenses have normal debit balances. To close them out, we are going to credit them. So we credit all of our expenses: salaries expense of $15,000, our rent expense of $6,000, our advertising expense of $3,000, depreciation expense of $11,000, and interest expense of $5,000. We zero them all out and prepare the corresponding debit to retained earnings. Remember, expenses and dividends reduce our stockholders' equity, which basically flows retained earnings into stockholders' equity. Then the last entry is to zero out our dividends for $3,000. To zero out our dividends, we credit our dividends for $3,000, and the corresponding account will be a debit to retained earnings for $3,000. In preparing these closing entries, we then have gotten rid of all of our temporary accounts. Then it asks us to create the ending balance of retained earnings. So if we go back to this initial slide, excuse me, wrong way. If we go back to the initial slide, we see that our retained earnings was at $30,000. So we start with $30,000. Then from there, we have revenues that increased our retained earnings, $56,000, and we see that by this $56,000, post this to the retained earnings account, $56,000. We have a retained earnings debit of $40,000 and a debit of $3,000, as you see those right here, the debit of $40,000 and the debit of $3,000. If we total our debits and we total our credits and subtract, we have a remaining retained earnings balance of $43,000. So we started the year with $30,000. The retained earnings at the end of the year is $43,000. And basically that's a result of the net income minus any dividends that were paid. Net income is the $56,000 minus the $40,000. Let's take a look at exercise 318. Laker Incorporated's fiscal year end is December 31st. Here is the adjusted trial balance. And as you see here, we've got the accounts showing their balances of debits and credits. And we're going to prepare necessary closing entries. We're going to calculate the ending balance of retained earnings. Then we're going to take it one step further and prepare a post-closing trial balance. So remember, what accounts are we closing out? The temporary accounts. The temporary accounts include dividends, the revenue, and the expense accounts. Everything below the retained earnings line here would be temporary accounts. So the first thing we do is close out our revenue accounts, which they have a normal credit balance. So to close them out, we will take the entire balance and debit it. Service revenue debited for $54,000. We credit the retained earnings for $54,000. This is basically increasing our revenue account. Our expense accounts get closed out by crediting those accounts, which means they have a normal debit balance, but to zero them out, we credit those accounts. So we credit them, and the corresponding entry is put as a debit to retained earnings. We do the same with our retained earnings. Sorry about that for things showing up. We do the same with our dividends. To close those out, we are going to credit dividends. They have a normal debit balance. We credit our dividends, and we then debit retained earnings to close out dividends. The balance in retained earnings will end up with $8,000. Now let's look at how we got that. Do you see that the retained earnings as of this fiscal or this particular statement shows $9,000 as the balance? So we start it with $9,000. We show the posting of those transactions, the 54, the revenues, the 51, the expenses, the 4 in dividends, gives us an ending balance of $8,000 in retained earnings. Now it asks us to prepare a post-closing trial balance. So one thing you'll be able to see from going back here is, the permanent accounts, cash, supplies, prepaid rent, accounts payable, common stock, notes payable, retained earnings. These are all permanent accounts. Nothing has been changed with these accounts. The only account that was altered is retained earnings, because we flowed the temporary accounts into our retained earnings. So we are going to copy the post-closing trial balance. Is basically going to be the adjusted balance of all the permanent accounts, with the exception of the changes in the retained earnings account. So as you see here, we have got the post-closing trial balance shows our cash, supplies, prepaid rent, our accounts payable, our notes payable, our common stock, but our retained earnings would be the new figure shown here. The new balance of $8,000 is how we get the retained earnings. Once again, we total our debits and total our credits in order to get to make sure we balance, and this allows us to be ready for the next period. We're going to go over a couple problems just to reiterate the concepts covered at the end of this chapter. This problem is 3-5B. A company, Orange Designs, provides consulting services related to decorating homes. It provides customers with recommendations for a full range of home decor, including window treatments, carpet and wood flooring, paint colors, furniture, and more. Here is the year-end adjusted trial balance of Orange Design. So this is the adjusted trial balance after all adjusting journal entries have been made. You see the initial at the top includes the assets are first, followed by the liabilities, followed by the stockholders' equity section. After that, then we have the income statement, temporary accounts, the revenues, and the expenses. As you see here, our debits equal our credits. Now this problem wants us to provide financial statements, the income statement, statement of stockholders' equity, and the balance sheet. The only thing it tells us in preparing the statement of stockholders' equity, note that during the year the company issued additional common stock of $11,000. So that is the only information that they are providing us with. So the first financial statement we will prepare is the income statement. The income statement has accounts that are revenue accounts and expense expense accounts. That is it. So we will take the information from this adjusted trial balance to prepare our income statement, starting with our revenues and our expenses. So as you see in this slide, orange designs, income statement, we always label what financial statement it is pertaining to. For the year ended December 31st, 2018. So we have our revenues, we total our expenses to have net income of $2,900. Now the next financial statement they want us to prepare is the statement of stockholders' equity. Now they gave us that information about the additional stock because we need to show changes in the stockholders' equity section. So we start the beginning balance of common stock, $49,000, our retained earnings, $16,000, for a total stockholders' equity of $65,000. Let's go back here and see how we have our retained earnings of $16,000 here to see that's what we began the balance in. This common stock here shows $60,000, and the reason the $60,000 is what we're ending the year with, but it's telling us we issued an $11,000 more this year. So that would mean to us we began the year at $49,000 of common stock. We began with retained earnings of $16,000. So our stockholders' equity is $65,000 at the beginning of the period. We included or added issuance of common stock for $11,000. Now that issuance of common stock is increased in the common stock section. We carry it over to the stockholders' equity section. From there, we take the net income we show on the income statement of $2,900 and we carry it over to the retained earnings section. And again, total that in our stockholders' equity. There were no dividends that were distributed during the year, so that will be $0. From there, we will have an ending balance, common stock of $60,000, retained earnings, our beginning balance plus what we've added to it is $18,900 for a total stockholders' equity of $78,900. Now, in order to complete the balance sheet, we have to have this information available to us. Remember, the balance sheet, we're going to use the information from the assets, the liabilities, and the stockholders' equity apart from the changes we've made to the retained earnings account, which shows up here. So as you see in the balance sheet, we take all of the assets and the liabilities straight off the adjusted trial balance. Our stockholders' equity section is coming from over here. The ending stockholders' equity of $78,900 shows exactly what we've comprised in the previous financial statement. Our common stock of $60,000, our retained earnings of $18,900 give us our stockholders' equity of $78,900. We need that information to fill in on our balance sheet. As you see here, the accounting equation plays out with our balance sheet. We've got assets equal our liabilities plus our stockholders' equity. Okay, one last statement we're going to look at, or problem. Problem 36B. It gives us the information for the income statement, the stockholders' equity section, and the balance sheet. Again, be aware of how these financial statements are interrelated. Our net income is derived here from 16.4 and is used to fill in the stockholders' equity section of net income 16.4. From there, the stockholders' equity section is needed to complete the balance sheet stockholders' equity section. The 132.7 is played out here, 132.7. Now, In this information, it wants us to prepare the post-closing transactions, and then our closing transactions, and then our post-closing trial balance. So when we talk about the transactions to clear out the temporary accounts, remember the year-end closing entries involve getting rid of the temporary accounts. The temporary accounts include revenue accounts, expense accounts, and dividends. So we know from this income statement our revenue has a balance of $89,700. We want to zero that out. We have 4 expense accounts here: salaries of $50,000, supplies of $10,100, rent of $8,500, delivery expense of $4,700. We're going to zero all of those out. In addition, we will also zero out our dividends account. That is a temporary account. So as you see on this slide, the first thing we do is zero out our revenue account. Then we zero out all of our expense accounts. Then we close out our retained earnings account. From there, we will create a post-closing trial balance. You'll be able to see all of these figures are the same as I don't have it in here. The adjusted trial balance, apart from there are no temporary accounts anymore. Our temporary accounts have gone right into our retained earnings. So once we have the post-closing trial balance, which only consists of permanent accounts, we're ready to begin the next year. That ends it for Chapter 3. Please review this over and over again so you can master these concepts. Have a good day.